All right, well, bonds are back. Let's start with the numbers here. What is the floor in yields for the 10-year?
So if you think about just the surprise that we've had over the last few months and ending the year pretty much where we started 2023. But it is different this time around because the central banks have let the cat out of the bag that I think they want to be easing policy from where they are. They do feel that they're in restricted territory and inflation is coming down. And I wouldn't be surprised if we do go towards 3.5 in the 10-year, first half of this year, and then possibly even lower in the second half. But it will depend on the data. It will depend on inflation continuing to do what the central banks believe it will do. And then we could go even further if we see weakness in the jobs market.
And how do the rate cuts price into that? We're looking at 5 rate cuts priced into the market right now. The consensus among economists is that the markets are way too ahead of themselves. What would be the surprise rate cut call for you?
The surprise rate cut call would be that they actually end up doing more. And if you go back through history and take out the last cutting cycle, because obviously they only managed to get rates up to a certain level, but previous cutting cycles, typically the Federal Reserve's managed 250, 260 basis points in the first year. So you could argue that 150 that's priced at the moment is actually not a lot. Now, in those scenarios, you've obviously had a deep downturn, and they've had to react, and that most people are expecting a soft landing and these sort of proactive cuts. But the risk is that they could end up doing more.
But if that risk is then ending up becoming basically a tailwind for the bond market, I'm curious what reverses it. I mean, it feels like the no-brainer is obviously if the inflation data goes in the wrong direction, but what might drive that?
I think if you continue to see resilience. So the big surprise last year was the strength of the consumer and how well that held up and how the jobs market didn't deteriorate, and the fact that we'd had these 525 basis points of hikes from the Fed and pretty much every other central bank around the world, and we hadn't really seen it hit the broader economy. And if that continues this year, and that the Fed start cutting and we continue to see the jobs market do well and inflation doesn't fall to where they want it to and maybe starts to re-accelerate, that's the big concern. And if you think back to Q3 of last year, that's what we were discussing then. Now, that feels like it maybe was a bit of a blip, but if we reappear to that sort of scenario, that's going to be a concern for the bond market and a concern for the central banks.